Hello and welcome to the Mehmi Group podcast. I'm your host Haider Malik, and today we're talking about finding the best value through financing when choosing between new and used trucks. Expanding or replacing your rig is a major investment, and the financing terms can make a big difference in your cash flow, total cost of ownership, and long term growth. Brand new trucks come with manufacturer warranties that cover engine, transmission, and emissions systems for years, giving you peace of mind on maintenance and repair costs. You also benefit from the latest fuel efficient engines and lower emissions to meet regulations. Captive finance arms often offer promotional rates as low as 5 to 6%, APR deferred payment options, and short term payment holidays. These incentives reduce carrying costs and smooth out your budget. Many new truck programs bundle maintenance and compliance updates into fixed monthly payments so you avoid unexpected expenses. The downside is the higher sticker price, which means larger loan amounts, higher monthly payments, and a down payment often between 10 and 20% of the purchase price. This ties up more working capital upfront and increases your debt service obligations. Late model used trucks typically cost 20 to 40% less than comparable new units, enabling lower down payments, smaller loan balances, and faster equity buildup. With a lower debt burden, you preserve cash reserves for fuel, payroll, and emergency repairs. Interest rates for used equipment generally run 1 to 3 percentage points above new truck rates, reflecting higher lender risk. Yet, even in the current market, used financing can be competitive in the 6 to 9% APR range. A well inspected used truck with a documented service history can deliver reliable performance at a fraction of the cost. Immediate savings on acquisition costs translate into lower total finance charges over the term and often faster return on investment. The risk is higher maintenance costs and potential downtime if components fail without warranty coverage. To objectively compare both options, request side by side financing proposals that outline down payment percentages, term lengths, interest rates, deferred payment periods, and any balloon or residual amounts at maturity. Calculate the total finance charge by summing all interest plus fees, then add projected operating costs, including fuel, insurance, and routine service. Next, estimate your truck's resale or trade in value after your intended ownership period. Subtract that from your total to arrive at a net cost of ownership for each scenario. Tax treatment also differs in Canada. You can deduct capital cost allowance on a purchased truck under Class 10 or 10.1 rules and write off interest and operating expenses. Lease payments on a leased truck are fully deductible as operating costs, but you don't build equity. Consult your accountant to model the cash flow and tax impact for your situation. Credit requirements and down payment flexibility vary by lender. New truck programs through OEM captives may accept lower credit scores or reduce down payments in exchange for higher rates, while independent finance companies often require stronger credit and larger upfront cash but offer more lenient terms on used units. Negotiate with multiple lenders and compare their rate tiers and approval criteria. You may find one lender has a lower rate on a used truck while another offers special rebates on a new lease. Insurance premiums can differ between new and used trucks. Newer models with advanced safety features like collision mitigation, electronic stability control, and telematics monitoring often qualify for lower renewal rates. Used trucks may attract higher liability or physical damage premiums, so get comparative insurance quotes for both options when evaluating your financing proposals. Maintenance budgeting is another key factor. New trucks usually come with scheduled service intervals and warranty coverage included in financing plans. Used rigs require you to establish a maintenance reserve to cover unplanned repairs. Aim to set aside 1 to 2% of weekly revenue per truck into a dedicated fund for parts, labor, and tires. Unexpected downtime can disrupt cash flow, so having a clear repair funding plan prevents emergencies from derailing your business. If you already own compliant or late model equipment, consider a sale, lease back to free up capital without adding new debt. Sell your existing truck to a financier and lease it back under a short term agreement. Apply the equity you release toward your new acquisition. This strategy smooths your transition while preserving liquidity. Finally, work with a financing partner who understands resale markets, parts, networks, and regulatory changes. A specialist can guide you to programs that align with your replacement timeline, risk tolerance, and budget goals. They can also help structure your financing to include fleet incentives, volume rebates, and loyalty discount.